Welcome back to Intermediate Accounting. In this video, we continue Chapter 16, Dilutive Securities and Earnings per Share. This video covers the following two main topics: accounting and reporting for stock option compensation and calculating basic earnings per share. Let's start by looking at accounting for stock option compensation. Here we see some information about why companies offer stock options as compensation to their employees. Stock options help motivate the employee to work hard for the company to try to increase the company's value, hopefully influencing and increasing the company's stock price. And then it rewards the employee because if the option is exercised and the stock price has gone up, then that difference is compensation directly to the employee. Let's now start writing down some terminology related to stock options. Options offer the holder, in the case that we're interested in, the employee, the right to purchase the common stock at a specific price and this specific price we call the exercise price or the strike price by a specific date. And we call this specific date the expiration date. So we say the employee or the holder is eligible to exercise the option anytime before it expires or before the expiration date. When an option is exercised, the employee pays cash equal to the exercise price of the option. And then the employee is given for that price, which is typically below the fair value on the date of exercise. The employee is given the stock. So it's almost like the company has this, the option is almost like a coupon that allows the holder to buy the stock at a reduced price. It doesn't necessarily mean it's going to be a reduced price, but if all goes well and the stock price increases from that grant date, the date the option is given, to the exercise date, that difference can become a valuable share of common stock to the employee, who can then choose to sell the stock for cash if they want to. So the employee pays cash equal to the exercise price of the option and receives the common stock in exchange. Again, if the employee wants to, they can hold on to that share of common stock or they can sell it for cash. The grant date is the date that the options are offered to the employee. GAAP requires companies to recognize stock option compensation, using what's called the fair value method. And under the fair value method, companies use some option pricing model. The most common is called Black-Scholes, and we don't need to know that. So this is typically the Black-Scholes model used to determine what the fair value is of those options. We'll be given that amount in our examples, but what we need to know is that fair value is, once we're given that fair value, we're going to allocate that fair value across the service period and record compensation expense over the service period. Let's look at that in a little more detail. Compensation expense is based on the, what did we just say in the last slide? Fair value of the options expected to vest on the date they grant the options to the employees, or the grant date. But we don't record compensation expense on the grant date. The compensation expense is based on the amount, the fair value on grant date. Then once we determine what that value is of those options, we then allocate or record compensation expense. So here's our bullet points: recognize compensation expense in the periods in which the employees perform the service for the company. And we call that the service period. The service period is either the vesting period or the expected period of benefit. Remember from when we talked about compensated absences, what a vesting period is. At the end of a vesting period, this award, the stock option compensation, is no longer contingent on future employment. So if the options are given and can be exercised anytime after a 2-year vesting period, then that's the period that we're going to allocate this compensation expense or the fair value of these options over that 2-year vesting period. If there is no vesting period, maybe the options can be exercised anytime once they are given, then we say that the service period is equal to the expected period of benefit. We would say, what is the expected time that our employees are going to work for us? That's the time that we're giving them this extra compensation as these stock options. And in our examples, we'll be given either the vesting period or the expected period of benefit, and we'll use whichever one we're given as the service period. If we're just told what the service period is, then of course we're going to use that. What are the journal entries that we need to know about related to stock option compensation? Well, on the grant date, remember what the grant date is. It's the date that the options are offered to the employees. There's no entry. We do need to determine the fair value of those options at grant date, but then once we determine that amount, we record adjusting entries. At the end of each year over that service period, we record compensation expense. We see here compensation expense is recorded as an adjusting entry at the end of each year over the service period. And what is that entry? So let's say at the end of the first year of the service period, what is that journal entry that will be recorded? Well, we're going to debit compensation expense. That's going to result in a decrease in net income, of course, just like a regular expense. And the account that we credit is a stockholders' equity account called paid in capital stock options. Just going to make a note here that this is a stockholders' equity account. So when we're crediting paid in capital stock options, we are increasing stockholders' equity. If the employee exercises the option, what do we do? Here's our journal entry that we're going to use to record the exercise of the option. We're going to debit cash, because remember we said when the employee exercises the option, they're paying out cash. To whom? To the company that offered this option. So the company receives the cash at the amount equal to the number of options exercised times the exercise price per share. The company is going to debit the account paid in capital stock options because, let's go back a slide, when we recorded the compensation expense, we increased this account paid in capital stock options. Once those options are being exercised, we no longer have a stock options account. Those options are gone, they've been exercised. We're going to need to credit. What are we giving out? We're giving out the shares of common stock to the holder of the option, our employee. And this is equal to the number of shares given times the par value per share. And then we credit whatever that difference is between our debits and our credits. We book that difference into the account additional paid in capital common stock, or paid in capital in excess of par on common stock. And this is for the difference between our debits and credits. We could also say that this is a plug number. What happens if the options expire and they had never been exercised? Why might this happen? Well, if the market price of the stock never goes above the exercise price, there's absolutely no reason why anyone would exercise the option. They're going to end up expiring or being unexercised. So what is this journal entry? When this happens, we're going to debit paid in capital stock options, because we still don't have these paid in capital stock options. Remember, again, we recorded this. When we recorded compensation expense, we increase the equity account paid in capital stock options when we no longer have them outstanding. And then we credit another stockholders' equity account called paid in capital expired stock options. So these are both stockholders' equity accounts. So there's no net change to stockholders' equity. Stockholders' equity is unaffected. Let's take a look at an example. On November 1st, 2019, the stockholders of Chen Company approve a plan that grants the company's 5 executives options to purchase 2,000 shares each of the company's $1 par value common stock. The company grants the options on January 1st, 2020. The executives may exercise the options at any time within the next 10 years. The option price per share is $60, and the market price of the stock at the date of grant is $70 per share. So this option price per share, this is the exercise price. So we're telling these executives, you are allowed to buy the stock for 60. On the day that it's granted, the stock is trading at 70. So the executives can exercise the option immediately and record 10, well, they can get the share of stock worth 70, sell that for cash, and immediately earn $10 per share if they wanted to. Under the fair value method, the company computes total compensation expense using an acceptable fair value option pricing method. The company uses Black-Scholes. Assume that the fair value option pricing model determines the total compensation expense to be $220,000. Assume that the expected period of benefit is 2 years. So we're granting these options to our executives and saying this is really relates to their next 2 years. We're giving them this incentive compensation for them to work for us for the next 2 years, or maybe they can't exercise them within the next 2 years. So let's see what these entries would be for compensation expense. On December 31st, 2020, well, we know what we're going to record. Debit to compensation expense. And a credit to paid in capital stock options, a stockholder's equity account. For how much? We're going to record it equal to, for compensation, record adjusting entry at the end of each year over the service period. So let's look at the total compensation expense. Total compensation expense is $220,000. And the service period, we're told, is the benefit period is 2 years. That's our service period. So let's divide that by 2. Compensation expense, let me move this over. Compensation expense, $220,000 divided by 2 is $110,000. What are we going to record at the end of the second year? Again, we're going to do the same thing, compensation expense for $110,000, and then we increase the stockholders' equity account paid in capital stock options also for $110,000. How about if the options are exercised? If Chen's executives exercise 2,000 of the 10,000 options, so 20% of the total amount that was granted, on June 1st, 2023, 3 years and 5 months after the date of grant, the company records what journal entry? Now, I'd recommend that you pause the video here and try to solve this note looking at your notes for how to record the exercise of the options. And then when you're done, resume the video to check your work. Remember, we said that the company receives the cash, a cash amount equal to the number of options that are exercised, in this case it's 2,000, times the exercise price for each one of these options. We saw that the option price per share is 60. So that's what the holder has to pay to the company. That's what the company receives. So cash goes up by 120,000. We want to reduce the stockholders' equity account paid in capital stock options, because these options have been exercised, so we take them off the books. At what amount? The fair value of the options that were exercised. So what is the fair value of these options? We know that all options, all 10,000 options, had a fair value equal to 220,000. How much were exercised? 2,000 out of the 10,000. So 2/10, 1/5, 20% of the options were exercised. So we can say of the total fair value of these options of 220,000, 20% were exercised, or 1/5. So let's remove off the books 44,000 in this paid-in capital stock options account. What are we issuing? We're issuing common stock. At par, how many shares of stock are we issuing? 2,000. Each option can be exercised for 1 share of stock, and the par value of the stock is $1 per share. So the common stock account increases by 2,000, and then the difference between our debits and credits is plugged into an account, paid-in capital in excess of par common stock or additional paid-in capital common stock. So we take the 120,000 plus the 44,000 we have in our debits, subtract out the 2,000 that we have as our 1 credit, and we get the difference as 162,000. What happens at expiration? If Chen's executives fail to exercise the remaining stock options before their expiration date, and again, this would only happen if the market price fell below the exercise price, below 60, then there's no reason to exercise. The company transfers the balance in the paid-in capital stock options account to more properly titled paid-in capital account, such as paid-in capital expired stock options. What would that journal entry look like? Look like just what we just said, debit to decrease paid-in capital stock options, and then increase a more appropriately titled account, paid-in capital expired stock options. So we can see here, these are both stockholders' equity accounts, so no net change to stockholders' equity. And then what is the amount that we're going to record our debit and credit? Well, we had a total amount of 220,000 as our stock option compensation, and we know that 20% was exercised, and so it's the remaining 80% that has not been exercised. This is the portion unexercised. 176,000. And what happens if, let's say, the employee quits before the options vested, or they, some other reason they didn't fulfill their service requirement? What happens then? Well, then the company reverses out the portion of those forfeited options. Remember, the initial entry was a debit to compensation expense and a credit to paid-in capital stock options. We just remove that entry with a debit to paid-in capital stock options and a credit to compensation for the amount of those options that were forfeited. Let's move on to basic earnings per share. We talked about basic earnings per share in Intermediate 1. Remember, it's the amount of income earned by each share of common stock. Remember, when there is discontinued operations, companies have to break down earnings per share into earnings from continuing operations and gain or loss from discontinued operations, and show the reconciliation, how it reconciles to net income per share. In addition to reporting basic earnings per share, companies also have to report diluted earnings per share. We'll get to diluted earnings per share in our next topic and next video. This one covers basic earnings per share. But to introduce you to what are dilutive earnings per share, well, what are the topics we've talked about so far in Chapter 16? Convertible bonds, convertible preferred stock, and stock options. All 3 of these securities are converted into common stock. So diluted earnings per share says, what if all of these holders of these convertible instruments did exercise the conversion feature and did have more, and the company had to issue more shares of common stock. What would that mean? That would mean that the denominator in the earnings per share calculation would increase, and that would dilute earnings per share for the existing owners. Again, here we see our basic earnings per share. That's all we're focusing on here. One more thing to add, we don't just take net income and divide by number of shares. Net income minus preferred dividends divided by, it's not just the number of shares that were outstanding. We've always been given that number, but what we're going to do in the remainder of this video is look at how do we come up with this weighted average number of shares outstanding. It's not just the number of shares that the company had on December 31st. What do? We take a weighted average, similar to how you would use a weighted average to calculate, let's say, your grade in a course, any other weighted average. We have to think of how many shares did we have at each point in the year, and for what portion of that year, or what fraction of the period was that number of shares outstanding. Let's take a look at an example. Frank's Inc. has the following changes in its common stock during the period. The company started the year with 90,000 shares outstanding, and then a few months later, April 1st, the company issued 30,000 additional shares. So between April 1st and then the next event date, July 1st, the company had 120,000 shares. On July 1st, the company purchased 39 shares as treasury stock, which reduced the number of shares outstanding. So from July 1st to the next event date on November 1st, there were 81,000 shares outstanding. On November 1st, the company issued 60,000 shares for cash. And so from November 1st to the December 31st, there were 141,000 shares. So we see how the number changes throughout the year. Let's calculate the weighted average number of shares outstanding. Every time we have one of these problems, let's set it up in a format similar to this one. Let's write out what are the dates that the number was outstanding. So for example, from January 1st, from one event date to the next, from January 1st to April 1st, there were 90,000 shares outstanding. What fraction of the year we're talking about here in our dates outstanding? January, February, and March. This is 3/12 of the year. So if we multiply the number of shares outstanding times a fraction of the year, we're going to get our weighted shares for each period, and then we're going to add them up to get the total weighted average shares outstanding. So 90,000 shares for 3/12 of the year works out to be weighted shares of 22,500. What's the next thing that happens? The company issues an additional 30,000 shares. So the company now has 120,000 shares outstanding from April 1st until the next event date, which is July 1st. 120,000 shares, you can ignore this. This is just how the 90,000 went to the 120,000. They were outstanding April, May, and June, so another 3/12 of the year, which works out to be 30,000. The next thing that happens is that the company purchases 39,000 shares on July 1st. So we reduce the amount of shares outstanding to 81,000, and that's between July 1st and November 1st. So what we did was we subtracted out 39,000. So we added 30,000 here. 120 minus the 39,000, we have 81,000 shares outstanding for July, August, September, and October 4/12. And that works out to be 27,000. On November 1st, the company issued 60,000 shares for cash. So we have now an additional 60,000. So from November 1st until year end, at which time we're putting together the financials and reporting our earnings per share calculation, we have 141,000 shares outstanding for 2 out of the 12 months, November 1st through December 31st. And that works out to be 23,500. We add all of this up to get total weighted average shares outstanding equal to 103,000. And that's going to be our denominator in our basic earnings per share calculation. Now, what happens? We looked at when companies issue unissued shares and when they buy back their stock and then reissue. What happens when the companies have stock dividends and stock splits? When stock dividends or stock splits occur, companies need to restate the shares outstanding before the stock dividend or split in order to calculate the weighted average number of shares. They restate the issuance of a dividend or split, but not the issuance of a repurchase or an issuance of stock. Let's take a look at another example. Sabrina Company had the following changes in its common stock account during the period. January 1st, the company starts off with 100,000 shares. March 1st, they issued 20,000 shares for cash. June 1st, the company has a 50% stock dividend. Where did these 60,000 additional shares come from? Well, on June 1st, they had 120,000 shares outstanding. We multiply that by the 50% stock dividend. This is the amount of additional shares given, 50% of the existing number. We add an additional 60,000. Now that the company, remember when we have the stock dividend, the company is no better off because each existing stockholder got half of a share more than what they had previously. So the company is no better off. So don't we need to make this beginning 100,000? Don't we need to adjust that for the split the same way we did the 120? Don't we need to adjust this additional 20,000 the same way that we just adjusted this 120,000? So you take this information and use it to update our same schedule that we had before. So we start on January 1st and we continue until the event date. The next event date was on March 1st. The company had 100,000 shares outstanding. So we continue just as we normally would. Hold off on the restatement because on March 1st, we still don't know anything about the restatement. And let's just work in the fraction of the year, January and February. So this is 2 out of 12 months. And we're not going to multiply anything yet at this point. We'll prepare the schedule at year end, at which point we'll know whether or not we need to go back and restate. So let's leave the restatement field and the calculation for weighted shares blank for now. From March 1st until the next event date, which is June 1st, the company issued an additional 20,000 shares. So the company issued 20,000 additional. So the company had 120,000 shares outstanding. Hold off on the restatement. We're looking at what fraction of the year, March, April, and May, 3 out of 12 months. On June 1st, the company issues a 50% stock dividend. So from June 1st to November 1st, that's the next event date. The next thing that happens is on November 1st. The company has what? They do a stock dividend and give every shareholder an additional half of a share. So let's multiply our number of shares outstanding by 1.5 because all of the 120,000 are still outstanding, plus an additional half of that, additional 60,000. That's going to give us total shares outstanding of 180,000. And they're outstanding from June, July, August, September, and October, so 5 out of the 12 months. Now that we know that we multiplied these shares by 1.5, we're going to do the same thing here. We're going to adjust for this restatement. And we're going to do the same thing to those initial 100,000 shares. We don't need to do it here. So there's nothing to do here other than Continue on to then multiply by the fraction of the year. Take the 180,000 times 5/12. We get 75,000. From March 1st through June 1st, we have a total weighted average shares of 45,000, and here we have 25,000. But there's one more event. On November 1st, the company issues an additional 30,000 shares. So from November 1st through December 31st, the company has 210,000. Add in 30,000 more shares. So the company has 210,000 shares outstanding. There's no restatement here. These are post-split or post-stock dividend shares. And this is outstanding for November and December 2 out of 12 as my fraction of the year. This works out to be 35,000. Then I'm going to add all these numbers up to get my total weighted average shares. Common shares outstanding equal to 180,000, and this would be my denominator in the earnings per share calculation. That concludes this video of weighted average shares outstanding for basic earnings per share calculations and our introduction to accounting for stock option compensation.